Why I don't chase high-risk reward ratios. One of the main reasons I don't execute high-risk reward ratio trades is psychology. Everyone wants to take such trades as they look very appealing, but they often come with lower win rates. Having a low win rate is not an issue if your profits outweigh your losses, but human nature doesn't like losing much, and I'm no exception. I initially started trading with larger reward ratios as per conventional examples, but I simply didn't feel comfortable with the drawdowns. A losing streak or a return from a significant profit to break even or the stop-loss level can be emotionally challenging. After a while, these experiences could lead to self-doubt, impatience, and a temptation to adjust your take-profit or stop-loss mid-trade. To be honest, it's not pleasant to see these kinds of trades. Many argue that you can only be profitable if you set high profits, but I disagree. With a smaller risk-to-reward ratio, you can significantly boost your win rate. I, for instance, feel more comfortable with a 70–80% win rate and being profitable 3 out of 5 days or even 4 out of 5. Additionally, partial closure options like halving positions and break-even points can help relieve some of the psychological burden. Once you know that you will be profitable using these methods, you can let your profitable trades run more confidently. Moreover, a higher win rate allows you to risk larger percentages in a single trade, for instance, 2%, 3%, or even 5%, if your statistics support it. Most likely, you will recover your losses sooner. I typically use a risk-reward ratio of 1:1 or 1:2, depending on market conditions. While a 1% profit may not appear significant, I will now illustrate with a table that, with a favorable win rate on an annual basis, it is not that unfavorable. Furthermore, with a 2% or 5% risk, it can yield remarkable results. Starting with $1,000, just a nice round number. Assuming approximately 261 weekdays in a year, minus holidays, vacations, and some days when trading opportunities are lacking, you would trade on about 200 trading days per year. Now, considering an 80% win rate and calculating 2 losses out of 10 days for the sake of conservative estimation, you would profit around $126 in 20 trading days with 1% risk reward, which is 12.6%. By the end of the year, that would sum up to $2,287.21, a 228.7% gain. If you risk 2% per trade, you'd earn $266 in the first month, or 26.6%, with an annual profit of $9,594.26, which is 959.43%. A 5% risk would translate into $777.96, a 77.8% profit in 1 month, and by the end of the year, you would have made $314,669.09, an astonishing 31,466.91% gain. Now, let's take a look at the 70% win rate. With 1% risk reward, you would make 8.22% at the end of the first month and 120.35% annually. With 2% risk, you would earn 16.89% in the first month and 375.98% by the end of the year. A 5% risk would result in a 45.54% monthly gain, with an annual profit of 4,164.99%. So, even with the lowest risk and a 70% win rate, you can achieve a 120% annual profit, which is not bad at all. That's why I believe you don't need high risk-to-reward ratios to be a successful trader. Please share in the comments what ratio you use. If you liked the video, don't forget to like and subscribe.